Thanks for watching this Magellan update. Today I'm speaking with Hamish Douglass, the Chairman, Chief Investment Officer, as well as Lead Portfolio Manager on our global equity strategies. Hamish, the Fed has recently altered its stance and its view around interest rates. Have you changed your opinion on interest rate directions?
Well, first of all, it's not exactly changed its stance. It's done a backflip. They were on a very, very clear path of tightening interest rates. If we went to the end of last year, they were predicting maybe another 2 or 3 rate increases this financial year, and they were predicting that they were going to shrink their balance sheet. And both of those have material consequences potentially for markets. And as we came into this year, not only are they signalling they're probably not going to increase interest rates any further this year, although some of the members have reserved maybe the ability to maybe do one, but they've also now said they're going to stop shrinking their balance sheet. So quantitative tightening is suddenly off the table. That is a very, very material shift. So of course it's had some impact on markets, and we then have to take that into account whether it's changed our view. First of all, I'd say is having a very, very strong view what's going to happen in the next 18 months, I think is very dangerous. That is dangerous because nobody knows. Even the Fed does not know what's going to happen. Clearly they were spooked at the end of last year by financial tightenings, and we saw a number of growth statistics around the world start to turn downwards. So the Fed has reacted to that information. What do we think? We think there's a number of scenarios that can play out, and that's how we think at Magellan. At the end of the day, I think the probabilities have increased that this interest rate cycle is going to be shallower. And that's important because that probability has gone up. So we are thinking about that in what we do in our portfolio. But we're not going to put a bet on black that there will be no inflation and interest rates won't have to be tightened. Because if we do get inflation, particularly in the United States, and the Fed has effectively running a too loose a monetary policy and they had to tighten, if that actually happened, hold on to your seats with what's being priced in the markets at the moment. We're not saying that will happen, but no one can tell you definitively that it won't happen either, and even the Fed wouldn't tell you definitively it won't happen. So yeah, we're pretty flattened our expectations, mainly because the Fed has taken out quite a lot of tightening out of the cycle. That's been reflected in markets. Markets have actually done very well since the Fed has done this backflip. So I would say we've probably moderated our view on the cycle, but we're still cautious, and we're going to keep a cautious stance of how we construct the portfolio to make sure that if the Fed's caught in the wrong direction here, we don't get caught in the wrong direction.
And Hamish, the portfolio's traditionally held defensive multinational consumer brands as part of that defensive part of the portfolio. Obviously the Amazon effect and technology generally is impacting this sector. What's your take on that overall part of the portfolio in terms of trying to find more defensive type businesses?
Yeah, that's actually been one of our biggest challenges, and I'd really say over the last 18 months that has been a big challenge for us. If normally half our portfolio sits in very defensive, very high quality businesses, and of that, if I went 5 years ago, maybe 80% of our defensive portfolio, that would be 40% of our total portfolio, was sitting in sort of defensive consumer staple names. It could have been a Procter & Gamble or a Colgate or a Unilever or a Danone or the like. And today we hold a very small portion of our portfolio, maybe circa around 10% of our portfolio in those sort of consumer staple names. So it's been a big shift, and a lot of the reason there's been a shift is because the prospects for those businesses as a group are not nearly as good as they were maybe 5 and 10 years ago. And quite a lot of the reason why it is because their revenue growth has slowed down, and I think you've hit the nail on the head. There's a number of structural shifts occurring. One of them, it's much easier now for brands, small brands, to get share of mind or brand awareness, as it was known. In the old days, it was very hard for a startup brand to get any material consumer awareness because it cost so much money. You literally had to go and advertise on television. And the barriers to entry in that were absolutely enormous. So Procter & Gamble and Colgate and Nestle, they could all advertise, in Unilever, But a small brand couldn't get that share of mind. And if you didn't get the share of mind, you were never going to get the shelf space in a supermarket, because you get no velocity in the shelves, and the retailers just weren't interested in you. And it created this massive economic moat around those businesses, and typically they would be growing their revenue at 3 to 5% very consistently. And they were great defensive assets, sort of essential goods with very high barriers to entry. What's happened with social media, things like Instagram and Facebook, they've dramatically reduced the barriers to entry for a new brand to get share of mind. And then the Amazon effect is they're not a physical retailer with a certain amount of shelves in a supermarket. They've almost got, if you can get share of mind, you can go and put it on their third-party platform in Amazon. It's got an unlimited number of shelves. Literally millions of goods can be sold on an Amazon, as opposed to maybe 20 or 30,000 individual lines in a big line supermarket. So the game's changed materially, and we think that is a big reason why the top line or the revenue growth of these businesses have slowed down, and for some of them it's going to get worse, and therefore we're generally cautious. And interesting, the market, partly due with low interest rates, in the share market's assessment of them, we don't think has fully reflected that reality.
And Hamish, the portfolio recently included an update on the holdings, and we noticed that, albeit a small position, a company named Berkshire Hathaway has crept into the portfolio. Maybe talk us through a little bit about the logic behind that inclusion, given that obviously we've written and quoted Warren Buffett in the past.
Yeah, obviously Warren Buffett and Charlie Munger have been hugely influential in our thinking. They really brought together the thinking of Benjamin Graham and Phil Fisher together. And if people are interested, incredibly, The Intelligent Investor by Benjamin Graham and Common Stocks, Uncommon Profits is a great book written by Phil Fisher, and they've really brought the two concepts together. So very influential on our thinking of types of stocks we would buy and how we would go about it. But you're right, we've never owned Berkshire Hathaway before. Partly leading into that, we used to have 40% of the portfolio in consumer staples. So we had plenty of things, very high return on equity, that were growing very things that were very easy to get your mind around, and that world's got harder. And Berkshire Hathaway actually fits into our defensive equities portfolio. It gets incredible performance when markets go down, mainly because there's $100 billion of cash. The business is so resilient, and it tends to go down very limited amounts when markets fall. So it fits into our defensive equities portfolio very well. And also their core business is an insurance business. They're underwriting workers' compensation, but a lot of catastrophe insurance. You know, as far as I've ever witnessed, hurricanes don't tend to follow stock market cycles. They don't tend to be correlated with each other. So actually the insurance premium cycle doesn't tend to follow typical economic cycles. It follows capacity issue cycles in the insurance. So fundamentally the business is not that correlated with the stock market, and it's got a lot of downside protection in it. I would say, and that's why we've come in now, because some of the things we used to do in defensive equity is harder. We bought some infrastructure assets, Crown Castle, a while ago. We bought Berkshire Hathaway. So we're doing some different things in that space. It's a business we really understand, but mindful, it's a small position. You know, I don't want somebody to think we're kind of a Berkshire Hathaway investment here. It's a small investment in our fund, but fits in that defensive side of the portfolio. And
you mentioned Charlie Munger and Warren Buffett. They're in their 80s. Does that worry you in the least?
Well, Charlie's actually in his mid-90s.
Oh, 90s.
So if he's in his 80s, I'd actually be quite happy, but he's older than that. And I think Warren's 88 at the moment. That does come into our thinking a bit. We're not worried about the long term. The insurance business of Berkshire Hathaway is truly one of the great businesses with massive competitive advantages in it. And we don't think anything would happen on the retirement or death of particularly Warren if that was to happen. What we're not putting a lot of value is is Warren's ability to find things to have another full cycle, to reinvest capital at extraordinary or get deals that no one else sees. And there has been an element of that, but we're not assuming any of that in our valuation of Berkshire Hathaway. So we'd love Warren to live till he's 103 and see another full cycle. That would be wonderful, and make decisions. His mind is as sharp as ever, and we'll probably get another puff on the cigar if that happens that we haven't factored in. There is no doubt that when Warren leaves Berkshire Hathaway, there's a whole lot of retail shareholders that would probably sell their holdings, and in the short period after the share price would probably get hit. It's probably one of the reasons we have a relatively small holding, because if that was to happen, that would be a wonderful buying opportunity for truly one of the great businesses of the world. As I said, that insurance business is, there's nothing like it outside of Berkshire Hathaway.
And we're currently seeing an inverted yield curve. Is that a precursor to a recession in your mind?
Well, a lot of recessions, and we're talking about in the United States, so not the whole of the yield curve is inverted. There's maybe the 3 to 10 year has been inverted. I haven't looked today whether it is, but that's part of the yield curve that inverted, which actually means the short-term interest, the 3-year interest rate's higher than the 10-year interest rates. And typically it's happened that they've been predictors of recession. And the reason they've been predictors of recession in the past is because the economies have been going very strongly. There's been a bit of inflation, and central banks are trying to stop inflation, so they keep jacking up interest rates. And they keep going, it has a lag, they keep jacking up the interest rates, and therefore they take effectively the short-term rates above the long-term rates, and it inverts. And because they're doing it to slow things down, effectively you often get a recession because it's late cycle. But we've got an inverted yield curve at much lower interest rates than we see where the curve typically inverts, and the Fed stopped increasing interest rates. So they're not trying to put the brakes on. If anything, they're going in the opposite direction. So I think when it's being inverted, much lower base, and the Fed's not trying to put the brakes on. So I do think it's very different for where it would typically predict a recession. So we're not calling the yield curve is predicting a recession at the moment.
Thanks, Hamish.
A pleasure, Frank.
And thanks for watching. And as always, feel free to pass on this video link to clients or colleagues where you think it may be of interest. Thanks.